Hey, what's up, everybody? We are back, and we are continuing our series on mortgage questions. Today, we are talking about PMI, and we're going to get started right now. Hey, what's up, everybody? It is Mark Hubert with My Front Range Living, powered by RE/MAX Integrity, and we are moving on in our series of mortgage questions. Today, we are talking about PMI, or private mortgage insurance. Once again, we are joined by my friend Kelly Elson at U.S. Bank. I am a full-time real estate agent here in Colorado Springs, and Kelly is a full-time mortgage lender here in Colorado Springs. Now, what's interesting about the differences between Kelly and I, yes, we're both devilishly handsome. However, I can only practice in the state of Colorado. Kelly, where can you lend money?
All states except for New York and Texas. They have kind of weird real estate laws.
So there you go. He can help you out in 48 states. So, hey, talk to me a little bit about private mortgage insurance. Everybody wants to know PMI, and it really does impact your monthly payment.
Yes.
All right, so what's private mortgage insurance?
It is, you may have heard, 20% down. If you're buying a house, the ideal ballpark wheelhouse is 20% down. If you're going to be putting less down, that's considered higher risk from the bank's point of view, from the lender's point of view. So that's where the mortgage insurance comes into play. Let's say, for example, you're putting 5% down, you're going to need mortgage insurance, and that's kind of the bank's guarantee that if for some reason you default on the mortgage, then they're not out that money. Okay.
And when we talk about down payments and how that can impact your mortgages, we just did the other video on some of the down payment assistance. You do not have to have 20% down.
Correct.
But you should anticipate if you come with less than 20%, you're going to have to pay that private mortgage insurance.
Yes, absolutely.
So is there a formula for how PMI is calculated in a mortgage?
Not necessarily. There's a lot of different factors that go into it. We always will get a quote from, there's certain companies out there that offer the mortgage insurance.
Okay.
MGIC is one of them. That's kind of one of the big hitters. And so our computer system will communicate with their computer system, and it'll just kind of import a quote as you're doing the loan application. So it kind of depends on where your credit score is, how much is your down payment. If you're putting down 15% versus say 4%, it'll vary based on that. But it can sometimes be expensive depending on the loan amount, credit score. I've seen it as high as $350, $400 a month. So
wow,
it can be pretty substantial.
Okay.
So that affects your overall approval rating too. So
okay, so. But you also said if you don't have 20% down, let's say I put 10% down, but the value of my home has increased, okay?
Yes.
And my loan balance is now about, I'm at that 20% threshold, loan to value, right? My value's increased. So can you look at refinancing to get rid of that PMI? How does that work?
So you actually don't have to refinance. It depends on the type of a loan. If you're in an FHA loan, years ago, if you had an FHA, that mortgage insurance would fall off at a certain point.
Just automatically?
Yeah, it would go away once you had enough equity in the home.
Okay.
Those days, I think it was 2015, that's no longer the case. Now FHA, the mortgage insurance, is on there for the life of the loan unless you sell the home or refinance.
Okay.
Other loans, like just a conventional loan, that mortgage insurance will fall off once you hit 20% equity.
Okay.
So like you said, the value has increased, say, over the past 4 or 5 years, or you've paid, let's say you get like an inheritance, somebody passed away in your family, and maybe you take $50,000 and you pay it towards that balance, then that mortgage insurance will fall off depending on the loan program.
And so when you say will automatically fall off in some of these programs, that's based on the value at time of purchase?
Correct.
Okay.
Yes, correct.
So if the market value does change, a $300,000 house within 3 years is now worth $320,000 to the market, right? Mm-hmm. The bank still sees your house as worth $300,000.
That's correct. You can reach out to your lender. Let's say you've been paying on your mortgage for 2 or 3 years,
sure,
and you feel like the value has gone up substantially. You can reach out to your lender and request that the mortgage insurance be removed.
Okay.
If you feel the value is there, and then they'll basically kind of send you a packet. You fill that out, and they can kind of go from there. So it does fall off automatically once you hit a certain threshold, but you can actually be proactive and reach out to your lender to try to get it removed before then.
So the down payment shouldn't hinder you from going out and buying a house.
Correct.
You just need to know that PMI may impact your monthly payment, until you get to that 20% threshold.
That's correct. Yeah.
All right. So we were also talking too, though, Kelly. There's a program you were talking about, LPMI, and it's so in addition to the private mortgage insurance, the PMI, there's an LPMI. What's that all about?
So that stands for lender paid mortgage insurance. So there's essentially two ways you can do it. You can do the borrower paid, where it's included in your monthly mortgage payment.
Okay.
And that's what most people are used to. There's loan programs out there that are called LPMI, or lender paid mortgage insurance, and it's essentially just a separate loan where the lender is going to pay that mortgage insurance for you. So it's not necessarily included in your monthly payment, but again, it's a trade-off. So in return for the lender paying the mortgage insurance for you, they're just going to charge a little bit higher interest rate. So maybe instead of 4%, they would charge you 4.25% or something like that, for example.
So while you may not have the monthly payment of the mortgage insurance, you're going to have that additional monthly payment of a little bit of percentage extra than you normally would.
Yes, but oftentimes what we'll do is if a customer doesn't qualify for, say, just a regular loan that has mortgage insurance attached to it, maybe their income isn't quite high enough, or whatever the circumstance is, we can try that LPMI loan program, because you're going to have a higher interest rate, but you're not going to have that mortgage insurance attached to the monthly payment. So it might, numbers wise, it might work to just go with the LPMI. You have a higher interest rate, but you don't have that mortgage insurance.
So it's just yet another loan program that could work for somebody in a great market where you think you got to have 20% and you don't.
Exactly.
I mean, there's really no reason to not be out there looking for a house if you're looking to build some equity.
There's a lot of programs, and that's just one example. There's a lot of programs that can help you not have the 20% down.
Excellent.
That's correct. Yep.
All right. Well, sweet. Hey, man. Thanks again. I appreciate your help today.
Thank you.
Hey, this has been another edition of Mortgage Questions, PMI edition, with my buddy Kelly Elson here at U.S. Bank in Colorado Springs. As always, we hope you found value in the video, and it would mean the world to us if you would go below and subscribe to our videos. We put out content every single week on Mondays. It shows up automatically in your inbox. It would also mean a bunch if you looked us up on Facebook and Instagram, our other social media platforms, at My Front Range Living. There, you can find some other stuff that we have going on, whether it be events that are happening here in Colorado Springs, or just some great places to eat and maybe find a beer while you're looking for homes and shopping mortgages. Once again, I am Mark with My Front Range Living, powered by RE/MAX Integrity. Thanks for stopping by. We appreciate it. Have an awesome day.